Hi, everyone. The entire Pembroke team and I welcome you to our last tax tips of 2021. My name is Stephanie Pantaleo, and I'm the Director of Family Office Services at Pembroke, and I'm joined by my colleague, Salaman Gamache, the Director of Financial Planning. Today's presentation, as you can guess, is all about estate planning. I will begin discussing the building blocks of an effective estate plan, beginning with an up-to-date will. And then I'll move into a discussion on the Canadian tax rules on death, as well as transfers or gifts of assets during your lifetime. Salaman will take the reins to discuss the Canadians' exposure to U.S. estate tax, as well as probate fees. So I'll begin with an introduction to estate planning, which is an integral part of wealth management. I'll preface this discussion by stating that there's not a one-size-fits-all to estate plan. And the thought for today is to present each of you with some thoughts while thinking about your own estate plan. And this begins with a will. And this isn't a will that you write, read once, and stick in the filing cabinet for, quite frankly, a rainy day. Estate planning is an ongoing matter. Your affairs, and therefore your will, must be reviewed from time to reflect changes in your life. A will is governed by the provincial law in which the testator, that's the individual making the will, resides. Your lawyer or notary in Quebec will guide you through this process. But put simply, a well-written will effectively controls who gets what, how much, and when. Some key considerations while drafting your will include choosing your executors and your liquidators. This individual or group of individuals will effectively be acting on your behalf following death to carry out your wishes and affairs. Therefore, this must be people that you trust. You'll also have to decide who your beneficiaries will be, and that is who will inherit your wealth following your death. And the options here, of course, are endless, from your spouse, children, other relatives, a neighbor, and even charitable organizations, which brings us to the third point on charitable giving. Often, individuals choose to incorporate charitable giving in their estate plans, and choosing to leave wealth to a charitable organization that supports causes that you feel a strong connection to. For business owners, the issue of succession will need to be addressed. And that is who you want to take ownership of the business and who you want to run the businesses. This could be two different people or two different groups of individuals. Now, although Salaman and I aren't lawyers, from our experience working with lawyers and notaries, all of whom have different styles when it comes to drafting wills, it's strongly recommended to be as specific as possible in drafting the will, just so that there's no question marks or ambiguity in the language. For example, when it comes to charitable giving, the preference is to state a specific dollar amount to be left to a designated charity, or say 10% of the net asset value of the TFSA account 1234 at the time of death is to be donated to a charitable organization. And I say that instead of stating, I would like X% of my estate to be donated to the nearby hospital. Evidently, the former two examples are a lot more clear and concise, and the latter one is open to interpretation, which you don't want interpretation when it comes to matters of leaving your estate to beneficiaries. Now, one may choose to incorporate certain vehicles like trusts and corporations in your estate plan, and some of you might even have corporations or trusts in your structure. While all asset holdings must be viewed as a whole in the development of your estate plan, trusts and corporations may assist in notionally subdividing assets based on their intended purpose or who will inherit such assets. A trust could be created during your lifetime, but it also could be created on your death by instruction of your will, which may further assist in administering your affairs post-death, especially when it comes to timing of distributions to beneficiaries, which may be a relevant factor based on the age of such beneficiaries. So say, for an example, an individual wants a child to inherit their wealth, but doesn't want to put money in the hands of a 20-year-old. While the timing of death is, of course, uncertain, the use of a trust can bring some certainty to control the timing of distributions to the adult child. Now, one matter we must consider when it comes to trust, especially setting up trust during our lifetime, is there's somewhat of an expiry on the trust, where in the 21st birthday of the trust, a choice must be made whether to recognize what could be a very significant tax event, which may force assets to be distributed from the trust in order to avoid that tax event. The timing of the 21st birthday of the trust should cause you to look at the age of the beneficiaries at that time in the future when this event will occur. With respect to corporations, in my view, a corporation may provide legal benefits of incorporating certain assets, where strictly from a tax perspective, there are very few benefits of incorporating investment income. And these are assets that are not used carrying on a business. Corporations that generate investment income are not subject to favorable corporate tax rates, and income splitting, that is paying dividends to lower income shareholders, is now limited with the introduction of new tax rules. So for sake of keeping this introduction brief by providing you with key aspects that you should consider in your estate plans, I haven't acknowledged the emotional side to this process, which is why some may avoid proper formal estate plans to begin with. Firstly, the topic of death in itself may be uncomfortable, and thinking about who will inherit your wealth, that too may not be an easy process because you're looking at your own family dynamics. Estate planning forces you to ask yourself questions where there isn't a right or wrong answer, but only you hold the answers to questions like, what do you want to see happen with your wealth during your lifetime and thereafter? Who do you want to inherit your wealth? And the answers to those questions are ultimately founded on your values, your goals and objectives, which is unique to each and every one of us. Hence why there's no one size fits all to an estate plan. So with that, we'll move to a topic where I could tell you that there is some certainty, and that's tax on death. Taxes are certainly an element that you should consider in your estate plan. In my view, the first step you should think about are what your objectives are, including who you want to inherit your wealth, and then consider the taxes as a result of that and determine whether there's any tax planning opportunities available. The final tax return of the deceased is known as the terminal return, and I'll speak to each of these items in a bit more detail in a moment, but these are typical items that are included in the terminal return. Firstly, we're looking at capital gains and losses, business income gains and losses that result from the deemed disposition of capital property on death. Second item that's very common is including the fair market value of the deceased RRSP or RIF at the time of death. And lastly, all income that's been received before death and any income accrued to the date of death is also included in the terminal return. If you ever find yourself in a position where you're acting executor or liquidator of one's estate, it's important to know that the terminal return, as well as the return for the surviving spouse, is due the later of 6 months following the date of death or the regular filing deadline of the taxpayer. So in more detail, capital property, that's investments, real estate, your home, depreciable property, non-depreciable property of a sole proprietor, for example, these assets are all subject to a deemed disposition equal to the respective fair market value on death. Therefore, all assets need to be valued at the time of death, which effectively forces the deceased to report all accrued gains and losses of property in the terminal return, which could give rise to a very substantial tax bill. The exception to this is that capital assets that are left to a spouse or common law partner are transferred automatically tax-free, which we refer to as the spousal rollover. There's an opportunity to elect out of the spousal rollover on an asset-by-asset basis to have the transfer occur at fair market value instead. And this provides flexibility to elect out of assets, purposely trigger gains to utilize losses, deductions, tax credits that would otherwise expire, or even purposely trigger losses to offset income from other sources. So speaking to our registered accounts, we'll start with the TFSA. And the general rule of the TFSA is that if the TFSA is inherited by anyone other than your spouse, the account will lose its tax-free status. If the TFSA is inherited by your spouse, it's important that they're noted as a successor holder in your will. And for provinces that allow named beneficiaries, you want to note your spouse as a successor holder, which is different than noting them as a beneficiary. And the reason for that is, as a successor holder, the deceased TFSA gets transferred automatically to the surviving spouse's TFSA. So it's administratively easier. If your spouse is noted as a beneficiary, the surviving spouse is going to have to fill out all this paperwork to transfer the deceased's TFSA to their own TFSA. There's a deadline that you need to do that by, and if that deadline is missed, then the surviving spouse will have to rely on their own contribution room. So if it's your wish to leave your TFSA to a spouse or common law partner, note them as a successor holder, not as a beneficiary. Now, RIFs and RRSP, I'm going to use those two interchangeably, but I'm referring to the same account, okay? Not as straightforward as a TFSA, just simply because it's a taxable account. The general rule is the value of the RRSP is included in the deceased terminal return. However, if the RRSP is left to a spouse or financially dependent child or grandchild, we call that a refund of premiums. And with that, the beneficiary who inherits the RRSP will include the value of the RRSP in their income instead of the deceased. Now, there's a further opportunity for the beneficiary to receive a corresponding deduction to offset that inclusion, so effectively receive the all or portion of the RRSP tax-free. If, in the case of a spouse that inherits the RRSP, the surviving spouse must transfer the deceased RRSP to their own RRSP or to annuity to the age of 90. In the case of a minor child or grandchild who inherits the RRSP, that child or grandchild must use the amount to purchase a term annuity to the age of 18. And in the case of an adult child or grandchild who inherits the RRSP, they must be infirm, and the amount must be contributed to an RRSP or term annuity to the age of 90. In addition to that, in the case where the beneficiary is disabled, regardless of whether they're an adult or minor child, they could also receive the deduction and receive the RRSP tax-free if they contribute to an RDSP, a registered disability savings plan. The beneficiary must make all of these necessary purchases or transfers by the normal RRSP deadline. So that's March 1st following the year of death. So there's options here to have all or a portion of the deceased RRSP taxed in the terminal return or in the hands of the beneficiaries, again, per the instruction of your will. The last component I'll speak to that gets included in the terminal return are income and losses that are occurred in the year of death. So income from employment, business income, other income that's received, net of deductible expenses paid to the date of death is included in the terminal return. Any accrued income that's not received by the deceased, that's interest income or net rental income in the month of death, must be included as well. There are options to file 3 additional elective returns in the year of death, so returns in addition to filing the terminal return. And the most common of these elective returns is called the rights or things return. Now, rights or things are defined as amounts that have not yet been paid to the deceased at the time of death, but if the person hadn't died, they would have been included in income when received. These types of income could be reported on a separate tax return, which may be beneficial to file to get access to a second set of graduated rates, multiplication of certain tax credits. Again, just beneficial information to know as an executor or liquidator of one's estate. So we'll shift the death topic aside for one moment until Solomon picks it up in a few minutes. But a common question that we're asked are, what are the tax implications of gifting assets or transferring assets during our lifetime, specifically to related parties? So be it a pre-mortem plan or just gifting out of the goodness of your own heart. And today we'll focus on gifting and transferring capital assets. And we have to distinguish the difference between a gift and a transfer. And another word for a transfer is just a sale, because the tax rules work a bit differently. So we'll start with gifts. By nature, The transferor, or the person that gifts the asset, receives no consideration for the asset. The transferor will report a disposition of the asset at fair market value may result in a tax bill. However, similar to the death context, assets that are gifted to a spouse just roll automatically at cost. They trigger no immediate tax consequences for the transferor. And again, there's flexibility to elect out of the spousal rollover and purposely trigger gains for tax planning reasons I gave earlier. However, when gifting assets to a spouse, any subsequent income or losses and capital gains and losses earned on that property thereafter will be taxed in the hands of the transferor, and we call that attribution. So it's not taxed in the hands of the spouse who had received the asset, the income is taxed in the hands of the transferor. For gifts to anyone else, there's a disposition of the asset at fair market value, but for gifts to minor relatives, there'll be attribution of any income and losses earned on that property back to the transferor until the child is no longer a minor. Unlike a gift, a transfer, more like a sale, is where consideration is received by the transferor for the asset. Again, the transferor will report a disposition regardless of the consideration received. Transfers to spouses, again, they roll automatically, triggering no tax, an opportunity there to elect out of the spousal rollover. But with respect to sales to spouses, fair market value consideration must be received, and the spouses must elect out of the spousal rollover to ensure that subsequent income or losses, capital gains and losses, don't attribute back to the transferor spouse. And for transfers to minors, again, fair market value consideration must be received from the minor to avoid attribution of any subsequent income or losses on the property. One important point I'll leave you with before I pass the presentation on is transactions between spouses. When electing out of the spousal rollover, a capital loss may not be claimed by spouses during their lifetime. That you can claim the capital loss on assets transferred as a result of death, but not transfers during your life. Finally, related parties must transact at fair market value to avoid adverse tax consequences. Some properties, are easy to value, but others like private company shares, real estate, may not be, and a proper valuation of these assets is required before transfer. Okay, so with that, Salomon, off to you.
Thank you, Stephanie. Hello, everyone. So now we'll cover a little bit of US estate tax exposure for Canadians. Next slide. So here, the most important word to keep in mind, it's an introduction. Because to be quite frankly with you, the US tax system is pretty different than ours. So the scope is large and we don't want to go too deep in that topic. So for today, it's a brief coverage just for you to think about that, maybe to raise some flags at some point, just to be careful about US estate tax. And again, neither Stephanie nor me are US estate tax or US tax specialists. At the end of the presentation, we have included some reference links from the IRS, which is the tax department from the United States, and also some tax organization expert on the field. So first of all, estate tax. It's based on the net fair market value of holdings at the time of death. The US is one of the countries that levies an estate tax. If you compare with Canada, here we don't have any estate taxes. However, the province, they have probate fees or taxes that I will cover a little bit in a couple of pages further. So Canadians should be cautious about their US estate tax exposure because there's a potential tax bill or liability at the time of death. And there's 3 different taxes: estate, gift, and generation skipping transfer tax. So as an example, I will refer to that example many times in the coming pages. Let's talk about Thomas. Thomas, let's say, is living in Ontario or Quebec. He's a Canadian resident, so he's not a US citizen. So he's living in Canada on a yearly basis, but he owns, as an example, a secondary residence. So let's say a chalet or cottage in New Hampshire or Vermont, as an example. Next slide. So let's say Thomas, again, as an example, in 2021, because of COVID, and he has the possibility to move south of the border, he stays in the US for 8 months. Or maybe he's a former employee of a US company and still has his green card. If you remember our last presentation we did this fall, so with a green card or with the substantial presence test, that means you count the number of days in the US, maybe you will be considered as a US resident or person for tax return. But here it's a totally different topic. It's not annual tax filing requirement, it's estate tax. And the domicile, it's a subjective test. It's based on the intention. So as an example again, Thomas, if he just owns a secondary property in, let's say New Hampshire, maybe the rest, so the principal residence, bank accounts, investment accounts, driver's license in Quebec or Ontario. So if you see the criteria on the screen, maybe, and most probably will be considered a Canadian resident and not a US person for estate taxes. Next slide. So here, a Canadian resident, not domiciled in the US, it's a non-resident alien. Yes, it's the real expression, non-resident alien of the US. So what that means in such a situation, you have 3 different kind of taxes. They call that transfer taxes. Estate tax, it's based on the US situs property. Situs is a Latin expression about where it's located. So, and it's owned at the time of death. So some example, that could be US real estate, US business assets, financial instruments, that means US stock or US options from US corporations, and some debt obligations, as an example. Secondly, you have the gift tax. So it's really US real estate or tangible personal property located in the US. Some example, that could be cash, furnitures, collectibles. The third one, the generation skipping transfer tax. So it's based on US real estate and various personal properties located in the US. And once the transferor give or transfer that to the second generation, let's say someone gives some, let's say, collectibles or furnitures to grandchildren, as an example. So if you keep that in mind, the 3 different tax, the IRS, how it works in a nutshell, you have the estate tax. Why they created the other 2, the gift and generation skipping transfer tax, is to avoid some person to say, okay, when I will pass away, there will be a tax bill. So in advance, I will start giving and transferring goods and furnitures and collectibles and real estate to family members, as an example. Next slide, please. Okay, this one, I will take a little bit more time to explain, and I'll be sorry in advance. I will try to keep it as simple as possible. But estate tax, it's applicable on the total value of assets at the time of death. I said that earlier, but first, any person who are not considered a non-resident aliens for US tax. So the credit for estate tax, it's 13,000. It's not a mistake. It's really 13,000. So that means a value of assets of 60,000. So think about Thomas, the cottage or secondary property in New Hampshire. Maybe it's worth 200,000 or 300,000 US dollars. So the exemption is based on 60,000. And maybe there's a tax bill in the future. I'll go back to this after. For a US domicile resident, so let's say a US citizen living in the US full-time basis, the credit is available and applicable. It's based on progressive tax rates. It starts at 18% and 20, 22, And again, going forward, up to the maximum tax rate for US estate tax of 40% for any estate amount over 1 million in US dollars. There's an exemption for them, and it's a significant exemption. It's worth an amount of 11.7 million. So it's an equivalent, if you do all the calculation with the progressive tax rate, it's like a tax credit of 4.6 million or so. So you see the huge difference. However, for Thomas, it's this example, thanks to the convention or the Canada and US tax treaty, a Canadian was a non-resident alien, and he has access to the previous amount of 1.7 million or the credit of 4.6 because it's prorated. It's an advantage because both countries, we have a tax treaty. So how we calculate that? It's on the formula at the bottom. FMV, that's fair market value. So the US estate tax credit will be calculated with, on top, fair market value of US citrus assets. So for Thomas, let's say that's the cottage. That's the only assets you have in the States. Let's say $300,000. Divide by the fair market value of worldwide assets. So let's say it's 3 million equivalent of US dollars. That means Canada, all the investments, property, including the US real estate. So if you do the math, 300,000 divided by 3 million, it's 10%. So the credit will be 10% times 4.6 million. So it's a little bit less than 500,000 tax credit instead of the 13,000 for any other person who was not a US person domicile. So you see, it's a huge difference. Next slide. So that being said, there's some strategies, we'll keep it on the surface, just not going too deep, but there's some possibility to mitigate or let's say diminish the US estate tax bill at some point. First of all, it's based on ownership of US property. So, which makes sense, it's to limit the holding of personal property. And don't get me wrong, I'm not telling you that to sell by tomorrow your US cottage or property in Florida. It's not the point. But as an example, I get that question twice this year. Someone's about to retire the next, let's say, 2 or 3 years and ask us about, is that good if I purchase something in Florida or Arizona just for, let's say, my retirement? So purchase or renting. Renting is another option, and you don't trigger that possible US estate tax bill in the future because renting, you don't own that real estate. Also, investments. If you invest in some, as an example, some US stocks like equities or derivatives options, it's different than if you own Canadian mutual funds unit, which are invest in the same US stocks. So maybe the strategy is so to diminish that US estate exposure in the future. Also, proper will planning and execution. Keep in mind, again, Canada and the US, totally different legal and tax system. And on top, in Quebec, the legal system is different. So quite often documents are in French. So if you own US properties, mostly real estate, and like snowbirds in Florida, so even if you have legal and valid legal and estate documents like a will in Canada, we strongly recommend maybe to ask lawyers and accountants specialized in the field in the US, because 2 sets of different legal documents, so one for Canada and one for the States, could be really useful at some point in the future for you. Next slide. Gift. So it's really at the time of death. So a strategy maybe is, okay, we'll start gifting and transfer to family members in advance. So just because if you remember the equation or the formula, there's 2 ways to diminish the US estate tax exposure. If you don't have at all, so a zero amount of US citrus property, there's no problem. Or if your worldwide estate is diminishing because you start giving some of your Canadian, let's say, property or money you have here in the country. The problem, like Stephanie said earlier, is the potential trigger of tax, because you dispose that, maybe it's not the best time possible in such a situation. So you better be careful of this. Also, life insurance, either permanent or term life insurance. So how it works, the person passed away, so there's a death benefit. So the check, it's sent from, let's say, the life insurance company to the beneficiaries. So in Canada, that death benefits, it's tax-free. However, to calculate the US estate tax, that could be part of the formula. So just be careful, not going further in that topic, but that could impact your US tax credit for this. And one last thing, non-recourse mortgage loan. So it's a specific kind of mortgage in the States. It's based on US real estate properties. So how it works, the mortgage will, for the calculation of the US estate tax credit, will diminish the fair market value of the estates. But it's complicated, the interest rate, it's way higher quite often than a regular mortgage loan. So I put it there as an example that exists, but it's really different than what we have in Canada. Next slide. One last thing. Again, it's different. In the US, there's 50 states. So each, they have a tax system. Tax rates are different. So just be careful of this before implementing any strategy. Don't think just about the federal tax rate and the legal stuff. Think about the US state tax also. Now we'll cover the last topic, the shortest one of the three. It's an overview of the probate fees in all the process. And again, it's an introduction because it's a legal topic, and Ontario and Quebec are quite different. Ontario, it's common law, Quebec, civil code. So just keep in mind that probate is the process to ask the court either to confirm and give the person the authority to act as the liquidator, trustee, or executor of an estate. Also, it's to formally approve that the deceased will is the last will and it's a valid one on a legal point of view. So because the probate process is not to confirm that, okay, that person gave a portion of the money and let's say assets to one family members, a little bit more than other family members. That's not the point. It's not the content of the will. It's the form. It's a valid form by the law. And also if it's the last will, because most of the time financial institutions, they want to distribute the assets of the person who passed away to the right person. So they want to be sure that the will, it's the right one and the last one. Next slide. Okay, let's start in Quebec. So here we have three different kinds of will. First of all, the notarial will made by a notary. So how it works, the notary, it's a specialized lawyer in Quebec. So, and really it's a will made by a notary, not a regular lawyer. So that means it's an authentic act. So it doesn't need to be probated at the time of death. After that, holograph wills must be entirely written and signed by you. It's handwritten will. So that means I can take right away a piece of paper with a pen and I can start live with you on screen, start my will, sign, and it's going to be a valid will. Is that going to be efficient? I don't think so. But yes, it will be a valid one. Third one, the will made in presence of witnesses. It's kind of the package you can find on the website. So you can order that or print that out. So you take the document, you fill all the boxes, and at the end you sign, and must be signed by two witnesses. So the last two are not legal or valid until it was approved by a superior court or notary. That's what they call the probate process in Quebec. Until that, the estate is frozen. So in Quebec, the fees for probate is really low, really minimum, almost zero. So it's not the problem. The point is it takes time to go to the court or all the process to be validated. So I also consider the fees of a lawyer and notary on top of it for the preparation of the documents. Next one. Probate in Ontario, pretty different. So take all the fair market value of the assets of the person who passed away. That should be, let's say, probated or part of the estates, except exclusion or exceptions, like you see on the screen. So assets that are not included in the probate. Assets, joint ownership. That means you have two persons own the same assets. So that's become the asset of the other person or the other owners. It's real estate, quite common. Also real estate outside of Ontario. So let's say someone with a secondary property in the BC or in Quebec, as an example. RRSPs, RIFs, TFSAs with the beneficiary designation. Insurance policies paid to the beneficiary indicate on the insurance policy. So you see the mechanism, how it works. You have the estate process, but you have many strategies to, in advance, take that assets that's going to be moved outside of the probate process. Also, debts will diminish or decrease the value of the estates, such as credit card debts, car loans, etc. So at the bottom, you'll see there's a quick calculation. And at the end of the presentation, there's some links from Quebec government and Ontario government also. You'll find for the Ontario government website a quick calculator. So you can enter the amount, and that's where it's coming from. So for 500,000, it's going to be a little bit less than 7,000 of probate fees in that example. Next slide. So again, some quick strategies to keep in mind to make it probate process. So, and mostly it's in Ontario. That's going to happen like for these strategies. So dual wills. So we have two different wills, one for assets to be probate, the other one for assets not subject to the probate process. So gift and transfers, living gifts and transfers, so may result in loss of control. And like Stephanie said earlier, possible tax implications. So be careful. There are many aspects of a strategy. You can name beneficiaries again on assets when it's applicable. So registered plan like RSPs and RIF. Keep in mind, if it's like you open your RIF or mostly your RSP many years ago, just good idea just to review your designation on these documents. And also hold assets jointly with right of survivorship, like real estate. But again, ensure your will is up to date. I think that's the most important advice we can give you. Be sure the document is up to date. Next one, Stephanie. So again, you have all the reference link. So for you to go see and take a closer look about all these topics we covered today. Over to you, Stephanie.
Thank you, Salomon. Well, thank you very much to everyone for participating and for your questions. I'm sure we will be in touch in the near future, but that's what you'll see from Salomon and I for us in 2021. So we wish your families a happy holidays and all the best in the new year. Thank you.
Thanks to all of you.